The following is a technical analysis on Applied Digital Corporation, a company of the financial services sector in capital markets here off the daily interval. And I believe we've reached a critical juncture of a significant magnitude where we have a very vast, steep, high volume at price indication with a huge volume profile gap in between below this key inflection point, where the vast majority of the masses have purchased around this $8 range. We have a concealed, hidden primary reactionary uptrend line cuts right through the gap of July of 2022, and it has played a significant role in the underlying near-term trend, where we've broken down here and then potentially put in a double-digit crash where we ended up backtesting it, had a multitude of reactionary highs and backtest and rejection right amongst that key inflection point, ended up recovering it, put in a reactionary low amongst that key inflection point, broke down, backtested it, put in a multiple 3 days of rejection and or backtesting, put in a sell signal there, backtested the 50-day moving average and never looked back, and put in more than a double-digit crash right off that key inflection point, where it ended up having a nice counter trend multi-month rally right back up into resistance amongst that key inflection point, rejected impulsively throughout that series of reactionary highs, once again correlating with the 342 price resistance called dual line of resistance, and again ended up crashing off a classic head and shoulder looking top here for more than double digit crash down below. And then once again we ended up gapping right up. We ended up breaking and closing right above that key inflection point, correlated with the 594 price resistance, put in a nice reactionary low right amongst that hidden concealed trend line, and never looked back. And that was good for, again, more than double digit gains right across that span of time, where we put in a very well-defined divergent high with steep negative and bearish divergences established amongst all three key technical momentum indicators. And I believe we've reached a critical juncture where we ended up backtesting off that divergent high, which was the catalyst for that double-digit drop, where bull traders and or long traders defended heavily that key inflection point once again, backtested once again, stepped in, consolidated briefly, backtested again, 2 or 3 more sessions in a row there, all for a whole span of an entire month there. And that was, again, defended heavily amongst that key inflection point, whereas you have the 50-day moving average hovering in up above now. I'll call it a dual line of support there, and we have cracked it. We've officially cracked that key inflection point. We've put in a back test right amongst that key inflection point, and we've been rejected pretty impulsively, putting in a potential sell signal where, again, when you have just a large volume at price profile around this range, that could be the catalyst correlating with damaging key technical momentum indicators with already a bearish crossover in the moving average convergence, testing the 0 line threshold as of now, and with the oscillator, whereas you have red candle, solid candle, red candle closes below that 0 line threshold there on the oscillator histogram, and that is a pretty well-defined sell signal in my opinion, which could carry us on, maybe even an additional back test to the 807 price resistance, and I begin scaling in process on a full short trade position size, onto a retest double-digit crash down to the 594 price support there. I'll take you to the charts here. And again, that's an additional down to the 594 price support there for 17.4% crash, down to $4.92 price support for 32% crash, which will more than likely correlate with the 200-day moving average. And that is a pretty well-defined and big and key inflection point to watch there, which will be at the top of the gap. And that needs to be defended heavily amongst bull traders and or long traders, if not on a complete backfill of the gap for a 54% crash if and when we get there, down to $3.42, and then ultimately the primary minor uptrend line there off the July 2022 reactionary lows for close to 60% crash. So again, we'll see what happens. Again, a nice key setup for a short trade position, and I believe there's more room for a much larger drop to come. Taking you out to MMC, a company of the financial services sector and insurance brokers here off the daily interval. And again, another key inflection point off this rising bearish wedge pattern. We've got put in a nice divergent high. We have equal exaggerated divergence here in the RSI. We have negative and bearish divergences amongst the oscillator and the moving average convergence, with a confirmed bearish crossover there on the moving average convergence and oscillator, with again here oscillator histogram printing red candle closes below that 0 line threshold, where it looks like we ended up breaking down, put in a solid sell signal daily red candle close. And we ended up backtesting it today, and could be a potential, an aggressive, a lot more aggressive short trade scaling in process here, where you could set some stops above those previous highs, where you could where you don't want to burn out those divergences, and an undercut of the 50 exponential and 50-day moving average down to the first target at 181.76 price support for a 5% crash, down to 176.87 for a 7.4% crash, down to 173.12 price support for a 9.5% crash, correlating with the 200-day moving average, and then ultimately 171.38 for a double-digit 10.5% crash if and when we get there. Bull traders, long traders, they want to defend this 50 exponential moving average really at all costs to avert that sell signal on a prolonged rally right back up, burning off those bearish and negative divergences, and keeping some of these technical key momentum indicators healthy above their 0 line thresholds. I'll keep you updated if I see any more significance here in the charts.